Oh, okay. This is Russ Squire with 1031 Property Exchange again, and we are back with 1031 Exchange for Accountants and Tax Preparers, Part 5. And this is on the property reinvestment decision, so we'll get right into it. Understanding the property investment decision. One, higher returns always mean higher risk. It's true across a gamut of investments, and it doesn't change when you're in real estate. Two, diversification by the type of property owned in the region of the country that it is owned in is important. Three, national tenants with a strong credit history and great location and a long-term lease make the best tenants. And that's really just the credit quality of the actual property being rented. And we always tell investors, don't get tempted into stretching for yield or concentrating too many assets in any one property type or region, because these are avoidable mistakes. It's just called diversification. So what type of properties can you invest in a 1031 exchange? Well, shopping centers, strip malls, multifamily apartment complexes, big box stores, industrial property, office buildings, retail stores, storage facilities, self-storage. There's a whole gamut. Pretty much anything that's held for business or investment purposes is a candidate for 1031 exchange. So determining the client's investment objectives, we tell realtors, you really got to look at their current financial situation, assets, liabilities, settlements, judgments, beneficiaries, all that kind of stuff. Their current financial assets, meaning, current cash position, current real estate assets, monthly income that they need, time requirements they have to create the income, and their ability to take risk versus the return required. Some people are quite comfortable with a lower return as long as they feel they're in a low risk situation. So where to invest? Well, what are the best markets, property types, what are the risks? Well, you can invest anywhere in the 50 states in a 1031 exchange, so it doesn't have to be in your own state, but we realize there's some people that are comfortable with something they can drive by and look at and touch every day. So that's really up to the individual. What kind of compromises are you willing to make in order to have something you're comfortable with? How to assess credit risk? Real simple. Dun & Bradstreet for individuals and closely held corporate entities and non-publicly traded companies, and Standard & Poor's for publicly traded companies. Those are the two best sources of information on assets, liabilities, and current risk levels that would be incumbent upon an investor investing with one of those companies or investing via a lease with one of those companies. How to further assess risks? Well, do a market analysis for the market you're going into, competition analysis, traffic counts, what are the competitive threats, community demographics, forecasted community growth certainly is an important one. Site and location visits is important. Talking with local, CCIMs or certified commercial investment managers isn't a bad idea. Environmental assessment, if the property needs an environmental assessment, certainly is something that's unavoidable. The use of leverage, leverage equals debt equals mortgage. So, does the internal rate of return on the investment or the capitalization rate exceed the interest rate of the loan? That's critical. And does the loan and the time period of the loan match up to the expected investment time holding period? Because if it doesn't, then you've got refinancing risks that will occur at some point in the future. What's the loan's term? What if we're forced to refinance the loan at a time period when the loan interest rate will exceed the capitalization rate? And that's something that's avoidable, based on the terms of any notes that are used, negotiated ahead of time. What is the property's appreciation potential, and not just its current rate of return from the flow of income payments? Does the use of leverage make sense? How old, how well capitalized, and how risk averse is the investor? Look at debt versus equity. That's the buyer's big decision. Debt financing is near historical lows, thus banks don't want to commit low rates on long-term fixed rates for anything besides a single-family home. Excuse me. Debt is usually, is secured by a first mortgage position on all these properties. Equity financing is expensive. So risk return trade-off, the return expectation, usually when you bring partners in on any type of development project, that equity is going to be looking for a 20 to 50% return, and to be taken out over a short period of time. What's the weighted average cost of capital? That's just that average cost between debt and equity. And understanding how a deal's financing is structured is paramount to risk analysis. It's absolutely critical. So in part 6, what we will do is we will go into 12 exchange rules. This is Russ Squire once again with 1031 Property Exchange, and we will see you in part 6.